Usually when we talk about a medical diagnosis, there is this expectation of like absolute uncompromising precision.
Oh, for sure. Like engineering.
Yeah, exactly. Like you break your arm, the x-ray shows that jagged white line right across the bone, and the doctor just points a pen at it and says, there it is. That is the problem.
Right. It is totally binary. I mean, the bone is broken or it isn't.
Exactly.
And we take immense comfort in that kind of visibility, I think. We like things to be easily categorized and cleanly defined.
We do. But then you step into the world of corporate finance, and suddenly that pristine x-ray machine is completely useless.
Oh, totally useless. It is a completely different landscape.
Right. You are looking at a diagnostic landscape that is, well, honestly, it is murky.
Yep.
It is full of competing priorities, hidden risks, and this relentless, agonizing tension between surviving today and growing tomorrow.
Which is terrifying for a lot of people.
It is. And if you are listening to this right now, I know exactly why you are here. You have a very specific high-stakes mission today. You are staring down the barrel of your upcoming MBA exam in corporate finance.
Specifically Unit 1, right? The introduction to corporate finance.
Yes, Unit 1. You are looking at a mountain of terminology, and you need a way to make all of this make intuitive sense.
Which is an incredibly common place to be. I mean, textbooks are excellent at giving you the vocabulary, but they often struggle to give you the melody of how a business actually breathes and functions.
And there's a great way to put it, the melody.
Yeah. So today, we are going to build those mental models for you. We are not going to just read bullet points. We are going to take these dry concepts from your source material and bring them to life.
Because by the time you sit in that exam hall, you shouldn't be trying to recall a memorized definition. You should be able to close your eyes and see the machinery of a corporation working in real time.
Exactly. That is how you ace the exam.
So let's start by anchoring us to a tangible example. The text actually uses this, and it is brilliant because it strips away all the Wall Street intimidation factor. I want you, the listener, to imagine that you are starting a firm to manufacture cricket bats.
I love this example. It sounds beautifully simple.
Right. You get some wood, you carve it, you sell it. But let's slow down and look at the actual sequence of events. First, you have to find and hire managers.
Yep.
Then you have to procure raw materials, like massive blocks of willow wood, specialized rubber for the grips, the twine for the handles. You have to assemble a workforce. And then finally, you actually produce and sell those finished cricket bats.
And if we pause right there and translate that into the language of your exam, you are making an investment in assets.
Okay, let's unpack this. Assets.
Right. You have current assets, which are the things you will use up quickly, like your raw willow wood and your cash on hand. And you have fixed assets, like the massive industrial lathes and bandsaws that cut the wood, or, the warehouse where you store them.
The big permanent stuff.
Exactly. But here is the fundamental law of physics in corporate finance. The amount of cash you invest in all those assets absolutely must be matched by an exact equal amount of cash that you raised by financing the business.
So perfect balance.
Yes. You can't buy a $10,000 lathe with $5,000.
Right. The money has to come from somewhere.
Yeah.
It is a closed loop. And then when you finally start selling those cricket bats to local sports clubs, your firm generates new cash.
And the cycle continues.
That continuous matching of invested cash with financing, and then utilizing those assets to generate new cash to create value, that is the absolute essence of corporate finance.
It really is the heartbeat. And I know that finance can seem incredibly daunting, especially when you open a textbook and you are immediately hit with a wall of acronyms and complex algebraic equations.
Oh, it's overwhelming.
But the secret to this exam is realizing that at its core, corporate finance is highly logical. It is simply the rigorous study of money-related decisions in a business.
Okay, so what is our roadmap for this deep dive?
Today, we are going to walk down a very clear, logical path. We will explore how the concept of finance has evolved over the last century. We will look at the exact decisions every financial manager has to make, the specific levers they pull.
The big four decisions.
Exactly. We will explore the ultimate overarching goal of a firm, which is often deeply misunderstood. We will tackle the human element where psychology messes with the math. And finally, we will look at how the finance function is actually structurally organized within a company to prevent disaster.
And as we go through this, we are going to be providing very clear memory hooks, not silly mnemonics, but solid conceptual frameworks so you can easily recall this during the test. Let's start with the big picture. The text refers to finance as the lifeblood of every business.
It is a heavy metaphor, but it works perfectly.
It defines finance broadly as the science or art of managing money. And an important distinction for your exam, despite the intimidating name corporate finance, this discipline applies to absolutely all businesses.
Right. It doesn't just mean massive conglomerates.
Exactly. If you are a sole proprietor making custom cricket bats in your garage, or if you are a huge publicly traded global sports conglomerate, you are doing the exact same three things.
Yeah.
You are planning, procuring, and controlling financial resources.
Precisely. The scale changes, but the physics remain the same.
But here is my initial pushback. When I think of a finance department, I just think of the people who make sure the check's clear. Isn't finance really just about making sure we have enough money in the bank to keep the lights on?
Yeah, as a highly intuitive way to look at it. And interestingly, it means you are thinking exactly like a top-tier financial manager.
Oh, nice.
From the year 1935.
Okay. So I am about 90 years behind the curve.
Just a bit. But it is a crucial historical stepping stone for the exam. In your coursework, this era of financial thought is explicitly referred to as the traditional approach.
Okay, the traditional approach. Let's dig into that.
You need to understand this contrast deeply. During the 1920s and 30s, think about the era of the Great Depression. Capital was incredibly scarce.
Right. No one had any money.
Exactly. The survival of a business depended entirely on its ability to just get its hands on cash. So the traditional approach was entirely, exclusively focused on procurement.
Just getting the money.
Yes. It was about raising adequate funds from the outside, maintaining basic liquidity, and having a sound enough financial structure that banks would trust you. The entire philosophy was basically get the money, put it in the vault, and don't run out of it.
Get the money, put it in the vault, and don't run out. I mean, I see the logic there. If I don't have money to buy the willow wood, I cannot make the cricket bats. If I cannot pay the electricity bill for the lathe, production stops.
So keeping the vault full seems pretty vital. What is the fatal flaw there?
The fatal flaw isn't what it did. It is what it completely ignored. The traditional approach treated finance as an episodic event.
What do you mean by episodic?
Like you go to the bank, you get a loan, you fill the vault, you lock the door, and the finance officer's job is completely done until you need another loan next year.
Oh, wow. So they just sat back and did nothing in between. Pretty much. It completely ignored the efficient allocation and the constructive, strategic use of those funds once they were actually inside the company. It paid almost zero attention to the day-to-day granular management of working capital.
So it is like filling up your car with gas, but then having absolutely no idea if your engine is getting 10 miles to the gallon or 50 miles to the gallon. You are literally just the person who buys the fuel.
That is the perfect analogy. The traditional approach was just buying the fuel. But a business is an engine. And if that engine is incredibly inefficient, it doesn't matter how much fuel you pour into it, you are going to break down.
That makes total sense. So when did this change?
This realization started to dawn on the business world in a major way post-World War II. The text notes that the need for the most profitable allocation of capital was finally, formally recognized during the 1950s. And this birthed what we call the modern approach.
What triggered that shift? Was it just that people got smarter?
Well, it was a combination of an economic boom and the advent of much better analytical tools. Businesses were growing rapidly, and it was no longer just about surviving a depression, it was about optimizing growth.
Okay, so a shift from survival to optimization.
Exactly. What's fascinating here is how the 1960s and 1970s completely revolutionized the toolkit available to a finance manager. Suddenly, scholars were introducing rigorous analytical models that allowed managers to actually measure how efficiently that fuel was burning.
What kind of tools are we talking about?
We saw the development of funds flow statements, we got complex ratio analysis, we got concepts like the cost of capital, earnings per share, or EPS, optimal capital structure, and modern portfolio theory.
So the 60s and 70s were effectively the Renaissance period for finance. It stopped being an administrative, reactive chore and became a highly proactive, strategic discipline.
Precisely. The modern approach dictates that you cannot simply procure funds and walk away. You have to properly mathematically allocate those funds to the best possible projects and then strictly utilize them to generate maximum return. So the definition of business finance expanded significantly. It fundamentally became the activity concerned with the planning, raising, controlling, and administering of the funds used in the business.
So if you want to master this for the exam, you need to lock in this mental model right now. The traditional approach is the vault. You just gather the money and sit on it. Procurement only.
Yep.
The modern approach is the engine. It is procurement plus efficient allocation plus utilization. You're gathering the fuel, tuning the engine, and driving the car.
And to fully solidify that, look at how the textbook synthesizes various modern scholars to define financial management today. They all converge on one incredibly practical idea.
Which is?
That financial management is simply applying general management principles to the financial resources of the enterprise.
General management principles. Like HR.
Exactly like HR. Think about a human resources manager. They plan how many people they need, they organize the teams, they direct the workflow, and they control the performance. A financial manager does the exact same thing, but their employees are dollars. They plan, organize, direct, and control the money. It is an operational activity that has to harmonize the individual motives of the people involved with the overarching goals of the enterprise.
Okay, so we have crossed the bridge from the 1930s into the modern era. We understand the philosophy, but I want to get granular now. I want to see this engine actually running.
Let's do it.
It is easy to throw around a phrase like finance is the lifeblood, but let's prove it for the students listening. Let's walk through the exact chronological journey of a business using our cricket bat factory and map it against the 8 specific reasons your text gives for why a firm absolutely requires corporate finance.
Walking through the business life cycle is honestly the best way to see how the need for capital constantly shapeshifts as a company matures.
All right, let's start at the very beginning. Ground zero. Stop number 1. Incorporation of the company. You literally cannot even exist as a legal entity without finance.
Nope. Before you even look at a piece of wood, before you hire a single employee, you are bleeding cash.
You need money for initial project reports to see if the market even wants your bats. You need to hire corporate lawyers to draft your Memorandum of Association, or MOA, and your Articles of Association, the AOA.
Let's pause on those terms because they appear frequently on these exams. Think of the MOA, the Memorandum of Association, as the external constitution of your company.
External constitution, okay.
It defines your boundaries to the outside world, what your company's name is, where it is located, and exactly what its primary object is. For us, it is manufacturing sporting goods. You can't suddenly start selling life insurance under that MOA.
It sets the perimeter.
Right. And the Articles of Association, the AOA, are the internal rulebook.
Like how the company runs itself.
Exactly. How are directors appointed? How are board meetings run? What are the specific voting rights of the shareholders? Drafting these documents requires very expensive legal expertise. Then, if you are raising public money, you need a prospectus. You have filing fees with the government.
And once you legally exist, you have to buy your fixed assets. The land, the factory building, the heavy machinery, and you need current assets, like your initial stockpile of raw materials. Finance is the spark that starts the entire engine.
It is the ignition.
Okay, so we get the factory built, legal fees are paid, the lathes are installed. Now we reach stop number 2, the smooth functioning of business.
This is where things get real.
This is the realm of working capital, and this is where the romantic idea of running a business crashes into the brutal day-to-day reality of cash flow, because your expenses and your revenues rarely happen on the same day.
That cash cycle mismatch is what kills most new businesses. Imagine your factory is humming along, you have 50 workers, and they absolutely expect to be paid every single Friday.
Right. If you miss a payroll, they walk out.
Exactly. You also have suppliers delivering wood every Monday, and they want to be paid within 30 days. So cash is constantly aggressively flowing out of your business.
But on the other side, we just shipped a massive order of 2,000 cricket bats to a major sporting goods retailer. That is great, right? That means we are successful.
It is great for your income statement, but not necessarily your bank account today.
Wait, why not?
Because that major retailer might have negotiated payment terms of 60 days or even 90 days. So you have made a sale, you are technically profitable on paper, but you don't actually have the cash yet. You still have to pay your workers this Friday.
Finance is the bridge over that terrifying gap. It ensures the business has the immediate liquidity to conduct its operations smoothly without seizing up while waiting for invoices to clear.
That is such a vital distinction for the exam. You can be a highly profitable company and still go bankrupt on a Tuesday simply because you ran out of cash.
Okay, let's say we manage that gap perfectly. The business is a massive success. We are dominating the local leagues. That brings us to stop number 3, expansion and diversification.
Which are two very different things.
Right, we don't want to just be local anymore. We want to go national. Or maybe we realize we have all this expertise in working with wood and composites, so we want to diversify. We want to start making field hockey sticks, or maybe cricket pads and helmets.
So expansion means increasing the scale of what you already do, more bats, wider area. Diversification means stepping into entirely new, perhaps unrelated product lines.
Both sound expensive.
Both are massive strategic moves, and both require phenomenal injections of new capital. You need larger, modern machines. You might need to buy the latest automated carving technology to compete at a national level. You need new marketing campaigns.
Growth consumes cash at an astonishing rate.
It really does. You cannot level up without a sophisticated corporate finance strategy to fund it.
Which feels great when it's going well. But then we hit stop number 4, which is the one that keeps managers awake at 3 a.m., meeting contingencies, the unexpected disasters.
The business environment is inherently chaotic and unpredictable. You could have a sudden macroeconomic recession that causes a massive fall in sales. There could be a natural calamity. A flood ruins your entire warehouse of raw willow wood.
That would be devastating.
Or you might get hit with a protracted multi-million-dollar patent infringement lawsuit from a rival manufacturer claiming you stole their grip design. Or your workers, unhappy with wages, might go on a prolonged strike.
If you're operating with zero margin for error, any one of those things is a death sentence.
Absolutely. A company requires a robust financial buffer, a war chest, to survive these unforeseen events. If you haven't managed your finances to account for contingencies, you are just waiting for a single bad stroke of luck to wipe out a fundamentally healthy firm.
It is the corporate equivalent of an emergency fund. All right, stop number 5 on our journey, research and development, or R&D.
Crucial for survival.
In today's hyper-competitive world, standing still is basically moving backwards. You have to continuously modify your old products to meet shifting consumer demands or invent entirely new products to maintain your market share.
Let's apply that to the bats. Maybe traditional wood is getting too heavy for the modern, fast-paced game. You need to research lighter, stronger composite materials for the handles or new weight distribution designs.
And that research is incredibly expensive. You are hiring material scientists, building testing facilities, running hundreds of failed prototypes.
And crucially, none of this R&D activity generates immediate revenue. It is a pure cash outflow today, designed entirely to secure your survival 5 years from now. Corporate finance is what allows you to fund the future while still surviving the present.
I love that framing. Funding the future while surviving the present. Okay, stop number 6. We have talked about machines and materials, but what about the humans? Motivating employees. The text explicitly lists this as a finance function, which might surprise some people who think that is purely an HR job.
HR designs the programs, but finance has to pay for them. A company's true limit is the quality and motivation of its people. To continuously improve performance, you need both financial and non-financial incentives.
The financial ones are obvious, right? Performance bonuses, higher base salaries, profit-sharing plans.
Right, but it is vital to recognize that the non-financial incentives are also major corporate finance decisions.
Right, because free perks aren't free to the company.
Exactly. Providing a fleet of buses to transport your factory workers from the city to the industrial park, building a high-quality subsidized canteen so they get hot meals, offering comprehensive health benefits or on-site childcare.
Those all cost a fortune.
All of these require a massive structured allocation of financial resources. Even the decision to upgrade the break room coffee machine is ultimately a capital allocation decision.
Okay, stop number 7. This is the inevitable one. Government agencies. The tax man. You have income tax authorities, sales tax authorities, the registrar of companies, customs and excise authorities.
The regulatory and tax environment is an absolute labyrinth. The company has a strict legal obligation to pay various taxes and duties accurately and on time.
And if you mess it up?
If you miscalculate your corporate income tax, or if you fail to remit the sales tax you collected from the retailers, the penalties can be devastating, up to and including the freezing of your bank accounts or criminal liability for the directors. Finance management ensures that these liabilities are forecasted, calculated correctly, provisioned for in the cash flow, and actually paid.
And finally, stop number 8 on the life cycle. Payment of dividend and interest. Let's circle back to the very beginning. You raised money to build this factory. Now, the people who gave you that money expect a return on their investment.
They didn't give you the money out of charity. If you issued shares of stock to equity investors, they want to see a return, often in the form of dividends paid out of your profits.
And what about the banks?
If you took out heavy machinery loans from a commercial bank, or if you issued corporate bonds to the public, you have a rigid legal obligation to pay regular interest. And eventually, you have to repay the principal amount of those loans at maturity. Corporate finance ensures you are strategically managing your cash to meet these obligations.
Which is the only way you maintain your creditworthiness so you can borrow again in the future. And just to be completely thorough for the exam, the text does mention a ninth point, which is essentially the circle of life completing itself. Replacement of assets.
Yes. That $10,000 lathe you bought in year one, after 10 years of carving bats, it is going to wear out, it depreciates, it becomes obsolete. You have to proactively plan financially to replace it before it breaks down entirely and halts your entire production line.
So when you look at that entire journey from filing the legal paperwork, to bridging the payroll gap, to funding a new composite handle, to paying the IRS, to rewarding your initial investors, and finally buying a new lathe, you see the reality. Finance isn't a department in a corner. It is the central nervous system of the organization.
It connects everything.
And because it touches every single nerve ending of the business, the modern finance manager cannot rely on gut feeling or simple arithmetic. They are forced to make highly structured, incredibly complex, analytical decisions.
Which brings us to the core of the course.
Exactly. This brings us to the absolute core of your exam material. If you are spacing out, dial back in right now. We are moving into the architecture of the course, the big four financial decisions.
This is the framework you must understand inside and out. Everything we just discussed about the modern approach, the allocation, the utilization, the forward-looking strategy, it all crystallizes into answering three fundamental questions.
What are they?
What is the total amount of funds our firm should commit? What specific assets should we acquire with those funds? And how exactly do we finance those required funds?
And to answer those comprehensively, the finance function is divided into four distinct, interrelated decisions. Let's break them down one by one. Decision number one, investment decisions. You'll also see this called capital budgeting decisions on the test. At its most basic level, this is deciding where to park the company's money for the long haul. It is about committing your finite financial resources to long-term profitable opportunities. You are agreeing to suffer a massive cash outflow today, writing a huge check in the anticipation that this asset will generate a series of cash inflows stretching over 5, 10, or 20 years into the future.
The word finite is key there. The constraint of reality is that capital is strictly limited. No organization, not even Apple or Microsoft, has infinite money.
So they have to pick and choose.
Exactly. Furthermore, a healthy business usually has a large number of potential investment opportunities available to it at any given time. Our Cricket Bat factory could buy a new automated CNC wood cutting machine. Or we could use that same money to buy a massive warehouse to store more inventory. Or we could use it to launch a massive advertising campaign in Australia.
But you can't do all three.
You have to choose. But they are not equally rewarding, and they are not equally risky. Therefore, the core of the investment decision is ranking these opportunities in an order of preference based on their expected risk and return.
Which sounds incredibly difficult.
This involves evaluating the prospective profitability of a new investment, which is one of the most agonizing things a manager does because you are essentially trying to predict the future. You are dealing with uncertain returns over an uncertain time period. The advertising campaign might flop. The CNC machine might break down. Risk arises precisely because of this profound uncertainty.
So if everything is uncertain and everything is risky, how do you mathematically pick? You can't just guess.
You have to establish a baseline, a cutoff rate. You calculate the prospective return of the new CNC machine. Let's say you estimate it will save you enough labor to generate a 6% return on your investment. Then you have to compare that 6% against a rigorous benchmark.
And what is that benchmark?
That benchmark is arguably the most important concept in finance, the opportunity cost of capital.
Okay, let's pause and double click on that. Opportunity cost of capital. That sounds like a guaranteed vocabulary question on the exam. I know opportunity cost in normal life means what I give up to do something else. If I go to the movies, the opportunity cost is the time I could have spent studying. How does that translate to corporate capital?
It is the exact same principle applied to dollars. The opportunity cost of capital is the expected rate of return that an investor could earn by taking their money and investing it in alternative financial assets of similar risk.
Okay, give me an example.
Let's say you want to use $1 million of the company's money to buy that CNC machine, and you project a 6% return. But what if your investors could take that same $1 million, go out into the public stock market, and invest in a mutual fund with the exact same risk profile and earn an 8% return?
Oh, wow. If I am the investor, I am furious. You are trapping my $1 million in a machine making 6% when I could be making 8% on my own. You are actively destroying my potential wealth.
Precisely. The opportunity cost of capital is the hurdle you absolutely must clear to justify making the investment. It is the required minimum rate of return. If the machine doesn't clear the hurdle, you don't buy it.
That makes perfect sense. Calculating that hurdle rate accurately in the real world, factoring in inflation, market risk premiums, and interest rates, is an incredibly complex mathematical challenge. If you are taking notes, the text lists 5 specific features of these investment or capital budgeting decisions. We have touched on them, but let's make them explicit for the exam. Number 1. They involve the exchange of certain current funds for future unexpected benefits. You know exactly what the CNC machine costs today. You only hope you know what it will yield tomorrow.
Right. Number 2. They involve the commitment of large or huge amounts of funds. We aren't talking about buying printer paper. We are talking about betting the company's future.
Number 3. They are irreversible, or at least only reversible at a catastrophic financial loss. If you build a custom factory building and then realize you don't need it, you can't just return it to the contractor for a refund. You have to sell it at a massive discount.
Exactly. Number 4. They fundamentally influence the firm's growth in the long term. And number 5. They directly affect the risk profile of the firm.
That is decision 1. Long-term assets, business risk, and clearing the hurdle of the cost of capital, which leads us sequentially to decision 2. Here's where it gets really interesting. Let's say the math works. The CNC machine clears the hurdle. We have decided what asset we are going to invest in. Now we face the next brutal reality.
We have to pay for it.
Yes, this is the financing decision, also known in the literature as the capital structure decision. And it essentially boils down to the ultimate corporate cage match. Debt versus equity. Where is the money coming from?
You are building your recipe. How much flour, how much sugar, how much debt, how much equity.
Exactly. You are determining your financing mix. Let's look closely at the 2 primary sources of funds, because understanding the psychological and financial dynamic between them is essential. First, you have equity.
The suppliers of equity capital are your shareholders. They are the actual legal owners of the firm. Now, they provide capital with absolutely no fixed or assured reward. They take on what is called residual risk.
Residual meaning whatever is left over at the bottom of the barrel.
Correct. If the cricket bat company goes totally bankrupt, the courts will sell off all the machines and the wood, the banks get paid first, the suppliers get paid, the government gets its taxes. The equity shareholders are at the very back of the line, which often means they lose their entire investment. They get nothing.
So why would anyone ever buy equity if they are last in line and have no guaranteed return? That sounds terrible.
Because in exchange for taking on that immense, terrifying residual risk, they demand 2 massive benefits. First, they get voting rights.
Yeah.
They elect the board of directors. They control the destiny of the firm. Second, and more importantly, they get the infinite upside.
The infinite upside.
Yes. If the bank loans you money at 6% and the company becomes the next Apple, making billions of dollars, the bank still only gets 6%. The equity shareholders get everything else. The reward is technically limitless.
Okay, so equity means ownership, high risk, no guarantees, but infinite potential upside. Let's contrast that with debt.
Debt providers are your commercial banks, your bondholders, your debenture holders. They are providing loan capital. Their arrangement is fundamentally different. They receive a fixed return in the form of interest, and this return is entirely independent of the performance of the firm.
Right.
Whether the factory makes $10 million in profit or loses $2 million, the bank expects its monthly interest payment on the dot. They generally don't have voting rights to run the company, but they have a legal contractual guarantee of repayment, and they are first in line to seize your assets if you default.
So the financing decision is just deciding the ratio. Are we a 50-50 company? Are we 80% equity and 20% debt? But how does a manager actually decide? Because I know this is a massive area of confusion for students. The text brings up this phrase, financial leverage or trading on equity. Can we really unpack this? Because on the surface, debt sounds terrifying. Why wouldn't a manager just fund the whole company with 100% equity and never have to worry about a bank foreclosing on them?
It is a phenomenal question, and the answer comes down to the cost of capital. Generally speaking, raising funds using debt is significantly cheaper for the company than raising equity capital.
Wait, hold on. Why is debt cheaper? The bank is charging me interest every month. Equity feels free because I don't have to pay a guaranteed dividend if we have a bad year.
It feels free in cash flow terms during a bad year, but from a valuation standpoint, equity is highly expensive. There are 2 main reasons debt is cheaper. First, look at it from the investor's perspective. The bank is taking on far less risk. They have a guaranteed return, and they are first in line if you go bankrupt. Because their risk is low, they are willing to accept a lower rate of return, say 6%. The equity investor is taking massive risk, so they will demand a much higher expected return, say 12% or 15%, to justify handing over their money.
That makes sense. What is the second reason?
This is crucial. In most global tax jurisdictions, the interest payments a company makes on its debt are tax-deductible expenses. You write them off against your profits. Dividends paid to equity holders are not tax-deductible. They are paid out of after-tax profit. So the government is essentially subsidizing your use of debt, making its effective cost even lower.
Okay, so mathematically, debt is cheaper money.
Yeah.
But that brings me back to my first question, just inverted. If debt is the cheapest money available, why not fund the company with 99% debt?
Because of the risk of bankruptcy. And this is where we get into the concept of financial leverage or trading on equity. Let's run a scenario to show exactly how this works. Let's say you need $100,000 to expand the factory. Scenario A. You use 100% equity. You and your partners put in the $100K. You have a boom year, and the factory generates a 15% return. You made $15,000 in profit. Your return on your equity is 15%. Not bad.
Sounds great. Safe and profitable.
Now, scenario B, the leverage scenario. You still need $100, Boo. But this time you only put in $50 of your own equity. You go to the bank and borrow the other $50 at a 5% interest rate. You have the exact same boom year. The factory generates that same 15% return on the $100 total investment, which is $15,000 in operating profit.
Okay, let's do the math out loud. I have $15,000 in operating profit. I have to pay the bank their 5% interest on the $50K I borrowed. That is $2,500. So I subtract that. $15,000 minus $2,500 leaves me with $12,500 in net profit.
Exactly. Now, what is the return on your equity? You only put in $50,000 of your own money, but you walked away with $12,500. That is a 25% return on equity. In scenario A, you made 15%. By using the bank's cheap money, you artificially boosted your own return from 15% to 25%. You used fixed charge sources to magnify shareholder return. That is financial leverage. That is trading on equity.
That is incredible. It literally feels like a magic trick. You've printed money out of thin air.
It is magic during a boom year. But leverage is a violent double-edged sword. It magnifies returns when times are good, but it ruthlessly magnifies losses when times are bad. Let's run the exact same scenarios, but this time the economy goes into a recession. Demand for bats plummets. The factory only generates a miserable 2% return on the $100K investment. That is $2,000 in operating profit.
Okay, scenario A, no debt. We make $2,000 on our $100K equity. That is a 2% return. It hurts. It's a bad year, but we survive. We just tighten our belts.
But in scenario B, the leveraged firm, you only made $2,000 in operating profit. But remember your fixed obligation. You owe the bank $2,500 in interest no matter what.
Oh, wow. So I take my $2,000 profit, hand it all to the bank, and I'm still short $500. I am taking a loss on my equity. If I don't have that $500 in cash lying around, the bank puts me in default and seizes the factory.
Precisely. Excess use of debt drastically increases the financial risk of the firm. Suddenly, a mild recession isn't just a bad year, it is a fatal event. So the finance manager has to strive for the optimum capital structure.
Which is what exactly?
So this is the holy grail. It is the perfect balance point where you are using just enough cheap debt to maximize the equity shareholders' returns, but not so much debt that you risk bankrupting the company during a downturn. Finding that perfect mix is the high art of the financing decision.
That is a brilliant breakdown.
Yeah.
I think that boom-bust mental model is exactly what you need for the exam. Okay, so we have bought the assets, that's investment. We have mixed the debt and equity to pay for them, that's financing. Let's assume the business is doing great. We survived the recession. We are highly profitable. We have a mountain of net operating profit after taxes sitting in our corporate bank account.
Yeah.
That brings us to decision 3. Dividend decisions or profit allocation. Whose money is it and what do we do with it?
It belongs entirely to the equity shareholders, and the manager really has only 2 alternatives for what to do with it. The first alternative is to simply hand it over. You distribute the cash to the owners in the form of dividends.
And the payout ratio.
Right. The proportion of the total profits that you hand out is called your dividend payout ratio. If you made $1 million and handed out $400,000, your payout ratio is 40%.
And the second alternative?
You keep it. You retain those profits within the business itself to fund future growth. Maybe buy another factory so you don't have to borrow more money. This is called retained earnings, or the plowing back of profits. The proportion you keep is your retention ratio. In our example, the retention ratio would be 60%.
So the manager is essentially playing a psychological game with the investors.
Yeah.
They're asking, do you want a smaller amount of cash in your pocket today? Or do you want me to reinvest this cash into the factory so the factory grows and your shares are worth twice as much tomorrow?
It is deeply psychological, and it depends heavily on who your investors are. If your shareholders are mostly retired pensioners, they might desperately want high current income to pay their living expenses. They want dividends
And then you
today.
can't wait 10 years.
Exactly. If your shareholders are young venture capitalists, they don't care about a tiny dividend today. They want you to plow 100% of the profits back into R&D so the stock price explodes over the next 10 years. They want capital gains. The optimum dividend payout policy is simply the ratio that makes your specific investor base the happiest, which in turn maximizes the market value of the share.
Okay, finally, decision 4. Liquidity decisions, also known as working capital management. We touched on this during the smooth functioning part of our journey with the payroll gap. This is the day-to-day battleground. This isn't about 10-year plans. This is about surviving Tuesday.
Exactly. Firm profitability, liquidity, and risk are all intensely associated with how you manage your investment in current assets. Things like cash, raw inventory, and accounts receivable, which is money your customers owe you. Here, the manager faces a constant grinding profitability-liquidity trade-off.
The idea of a trade-off implies I can't have both. Let's say I am terrified of that payroll gap. I want to be as safe as humanly possible. So I just hoard cash.
Yeah.
I keep $5 million sitting in a basic corporate checking account, and I stuff the warehouses to the ceiling with raw wood so we never run out. What is the problem with that? That sounds incredibly secure.
It is incredibly secure. You're highly liquid. You will never default on a short-term bill, and you will never suffer a production halt due to a lack of wood. But what is that $5 million doing while it sits in a checking account?
Nothing.
Nothing. It is idle money. In an environment with inflation, it is actually losing purchasing power. It is earning zero return. If you had taken $3 million of that and invested it in a new product line, you could be increasing your profits by 20%. By hoarding current assets, you are actively destroying your firm's overall profitability. You are punishing yourself for being too safe.
Okay, so let's swing the pendulum the other way. I want maximum profitability. I take every single spare dollar we have, and I invest it in high-return, long-term R&D projects. I keep my cash reserves at absolute zero. I use just-in-time manufacturing, so I only order exactly enough wood for today's BAPs to keep inventory costs at zero.
And you are highly profitable right up until the moment a delivery truck breaks down or a customer pays an invoice 3 days late.
Because I have no buffer.
Right, because you have zero liquidity, you miss payroll, your workers strike, your suppliers cut off your credit, and the company is forced into sudden insolvency. So too much working capital means you are safe but unprofitable. Too little working capital means you are technically profitable, but you are constantly teetering on the brink of catastrophic bankruptcy.
Current assets must be managed with a surgeon's precision to safeguard against insolvency while not dragging down overall returns. Okay, let's pull the camera all the way back. If we look at the core diagram in the text, figure 1.1, it shows all 4 of these decisions: investment, financing, dividend, and liquidity. And the connecting thread, the unifying theme of everything we have just discussed, is a constant tug of war.
An inescapable trade-off between return and risk.
Yes. If you want higher returns on a machine, you take more risk. If you want the high returns of debt leverage, you risk bankruptcy. If you want the safety of high liquidity, you sacrifice profitable returns. But here's the multi-million-dollar question. How does a manager decide where on that spectrum they want to be? What is the North Star?
This is where a lot of people get confused.
What is the ultimate unifying goal driving every single one of these financial decisions? This brings us to a massive conceptual shift. Because I think 99% of people, if you stop them on the street and ask, what is the goal of a business? They would look at you like you're crazy and say, to make the most profit possible. Profit maximization. It is the core tenet of capitalism, isn't it?
It is undeniably the most commonly cited goal in popular culture. But from the rigorous perspective of modern corporate finance, it is a deeply flawed, almost dangerous operating principle.
Dangerous.
Your textbook explicitly calls the goal of profit maximization vague and ambiguous, and for the exam, you have to be able to articulate exactly why it fails as a guiding North Star.
I mean, I will play devil's advocate. Why does it fail? It seems elegantly simple. If I am the manager of the cricket factory, my job is to make the number at the bottom of the income statement as big as possible. More money is better than less money. What is ambiguous about that?
The fatal flaw lies in 2 areas, the time frame and the definition of the metric itself. First, let's look at the time frame. If the board of directors hands you a mandate that simply says, maximize our profits, the immediate question is, over what time period?
Oh, I see.
Do you mean maximize profit this quarter, this year,
Wow.
or over the next decade. Because the actions you take to maximize short-term profit are often the exact actions that will destroy the company's long-term viability.
Okay, walk me through that. How do I ruin the company by making it profitable?
Let's say your year-end bonus is tied entirely to this year's net profit. You want to inflate that number. What are the fastest ways to cut expenses? You completely halt all preventative maintenance on the factory lathes.
Oh, boy.
You fire the entire R&D department researching the composite handles. You slash your raw material inventory to dangerously low levels to save on warehousing costs. You cut employee training programs to zero.
All of these are immediate, massive cost-cutting measures.
Yes. Your expenses drop precipitously, which means your profit margin for this current calendar year will look absolutely spectacular. You will be hailed as a genius manager.
Right. But I can already see the cliff approaching. Next year, the lathes break down catastrophically because they weren't oiled or maintained. Production halts. 2 years from now, our competitor releases a composite bat that makes our wooden ones obsolete, and because I fired R&D, we have no response.
You lose your market share entirely.
We have constant stockouts because our inventory was too lean, the company collapses.
Exactly. Profit maximization completely fails to tell the finance manager what the appropriate trade-off is between current earnings and future earnings. It encourages short-term destructive behavior. Furthermore, even if we agree on a time frame, the actual accounting definition of profit is ambiguous.
Wait, profit isn't just a hard number.
Not at all. Does the mandate mean maximizing total corporate profits or earnings per share? Does it mean maximizing net profit after taxes or operating profit before taxes?
Depending on which accounting metric you pick, you could make totally different decisions.
Exactly. And the final nail in the coffin, the simple mandate of maximize profit ignores the concept of risk entirely. Let's say you have $1 million in the corporate treasury. You could invest it in government bonds for a guaranteed, safe $50,000 profit. Or you could take that $1 million, fly to Las Vegas, and put it all on black at a roulette table.
If you win, you make $1 million in profit.
Right. If the mandate is purely maximize expected profit, the math might actually tell you to play roulette. But the risk of losing the entire company's treasury is catastrophic. Profit maximization provides no framework for evaluating risk.
The text actually drops a really famous quote here to highlight the problem with ambiguous time horizons. It's from the legendary economist John Maynard Keynes, though the text just crazily refers to a famous economist. The quote is, "In the long run, we are all dead."
It is a dark, cynical, but highly effective way of saying that a goal without a strictly defined time horizon is analytically useless. If you tell me to maximize profit over the long run, well, eventually the universe ends, so what does that even mean?
You need something better.
We need an objective that automatically encompasses both the short-term reality and long-term sustainability, that accounts for the time value of money, that adjusts for risk, and that isn't easily manipulated by clever accounting tricks.
Okay, so we have torn down profit maximization. What is the superior goal? What is the actual North Star that a modern finance manager follows?
If we connect this to the bigger picture, the true objective goal of financial management is wealth maximization. More specifically, and this is the exact phrase you need to internalize for the exam, the goal is to maximize the current market value per share of the existing stock.
Maximize the current value per share. Let's break down why that solves all the problems we just listed.
It elegantly resolves every ambiguity. First, look at the time frame. Unlike a single year's accounting profit, the market value of a stock is an inherently forward-looking, long-run phenomenon. In financial theory, the stock market prices a share today based on the present value of all future expected cash flows of the company, stretching out to infinity, discounted back to today.
Okay, so if a manager tries that trick of firing the R&D department to artificially boost this year's profit,
the stock market isn't stupid. The analysts will see that the company's future growth potential has been sacrificed. They will adjust their future cash flow models downward, and the stock price will actually drop today.
Because the market is pricing in the future disaster. So the manager is instantly punished for short-term thinking.
Exactly. The goal of maximizing the current stock value forces the manager to perfectly balance short-term performance with long-term investment because the stock price reflects both simultaneously. Second, wealth maximization relies on the bedrock concept of actual cash flows rather than accounting profit.
What is the distinction there?
Accounting profit is an opinion. It is subject to all sorts of non-cash depreciation schedules, inventory valuation methods, and complex accounting rules that can be entirely legally manipulated to make the numbers look better or worse than they really are.
And cash flow.
Cash flow is a fact. It is precise. You either have the cash in the bank or you don't. Measuring the benefits of an investment opportunity in terms of actual cash generated removes the ambiguity of accounting. And finally, wealth maximization provides a definitive mathematical answer to the risk-return trade-off.
How does it handle risk better than profit maximization?
Because investors in the stock market demand a higher rate of return for taking on higher risk. If a manager proposes a highly profitable but insanely risky project like putting the treasury on black at the roulette table, investors will severely discount the value of those potential future cash flows because the risk of failure is so high, the stock value will drop.
Therefore, the manager won't do it.
Exactly. Every single decision we discuss, the investment decision, the financing decision, the dividend policy, the liquidity management, can be objectively evaluated by asking one incredibly simple question. Will taking this specific action increase the current market value of our stock? If the answer is yes, you do it. If the answer is no, you don't.
That is a phenomenal mental model. If you are preparing for this exam, you must be able to articulate why wealth maximizing current value per share is inherently superior to profit maximization. It resolves timeline ambiguity by being forward-looking. It focuses on precise, factual cash flows rather than accounting opinions. It mathematically accounts for risk, and it inherently balances the short run and the long run. It is the perfect North Star.
It really is.
Okay, so we have the rules of the game. We know the decisions to be made, and we know the ultimate goal is to maximize shareholder wealth. Now, we have to introduce the chaos factor. We have to talk about the flawed humans who are actually playing the game. Let's move to the concept of the finance manager and what is famously known as the agency problem. Let's start by weaving the manager's actual roles into everything we've learned, just to make sure we hit the 7 specific points from the text for the exam.
Let's look at a day in the life of this manager. Their role encompasses 7 broad categories based on the Big 4 decisions. 1. Analyzing and evaluating investment activities. They are constantly scanning the horizon, deciding where to allocate funds for maximum safety and return. Is the CNC machine better than the Australian ad campaign?
Right. 2.
2. Estimating capital requirements. They are looking at the production forecasts, the raw material costs, and predicting exactly how much cash the business will need next quarter. 3. Determining capital composition. The endless debt versus equity analysis. Should we issue new shares or go to the bank? 4. Management of surplus. The dividend decision. Negotiating with the board on whether to pay out the profits or retain them. 5. Management of cash. The daily liquidity battle. Ensuring payroll is met, suppliers are paid, and excess cash isn't sitting idle.
And then there is point 6, financial control. The text mentions using techniques like ratio analysis, financial forecasting, and cost volume profit or CVP control to monitor performance. Let's briefly intuitively define CVP, because that sounds like heavy jargon.
CVP, or cost volume profit analysis, is essentially studying the interactive relationship between your prices, your costs, and your volume of sales. It is modeling what-if scenarios.
Okay, give me a quick example.
For example, let's say we currently sell our cricket bats for $100. Our variable costs, the wood and direct labor, are $60 per bat. That leaves a $40 contribution margin. Our fixed costs, like factory rent, are $10,000 a month. To break even, we have to sell 250 bats. But what if a competitor drops their price?
We have to model a response.
The manager uses CVP to model, if we drop our price to $90 to compete, our margin shrinks to $30. Now we have to sell 334 bats just to break even. Do we believe we can boost our sales volume that much by dropping the price? It's using math to control strategy.
That's a perfect explanation. And the final role, point 7. Understanding global capital markets. Even if you are a local manufacturer, your raw materials might be priced in global commodities markets. Your bank's interest rates are influenced by global central banks, and if you are publicly traded, your shares are part of a global exchange. The manager must understand how world capital markets function.
So when you look at that list, you realize something profound. The finance manager has an absolutely incredible amount of power. They are controlling the lifeblood, the strategy, and the survival of the organization.
So what does this all mean?
It means we have a fundamental friction, a crack in the foundation of modern corporate structure. The people managing the company, the executives pulling the levers, are usually not the people who own the company. You have a strict separation of ownership and management. The millions of individual shareholders own the firm, but they hire a few professional managers to run the day-to-day affairs.
And this structural separation creates what economists call an agency relationship. This exists anytime someone, the principal, hires another person, the agent, to represent their interests and make decisions on their behalf. If you hire a real estate agent to sell your house, you are the principal, they are the agent. In a corporation, the shareholders are the principals, and the executives and finance managers are the agents.
Exactly. And the entire system is built on the assumption, the hope, really, that the managers will act selflessly in the best interests of the shareholders, constantly striving to maximize the stock value.
But human nature being what it is, there is always the possibility of a massive conflict of interest.
And that conflict is the infamous agency problem. It is the very real likelihood that managers may place their own personal goals, like ensuring their job security, demanding higher salaries, acquiring luxury corporate perks, or building a massive corporate empire just for their own ego, above the overarching corporate goal of maximizing shareholder wealth.
Let's use the classic real-world scenario provided in the text. Let's pivot slightly from cricket bats to a pharmaceutical company, because the risk dynamics here are fascinating. The company has the opportunity to invest massive amounts of capital into researching a radical new experimental drug.
This scenario perfectly illustrates the tension. Look at this investment from the perspective of the shareholders, the true owners. An individual shareholder might own stock in 50 different companies across various industries. They are highly diversified. They look at this new drug project and think, yes, it is incredibly risky. It might fail clinical trials and cost billions. But if it works, it cures a major disease, and the share value of this company will skyrocket. Because I am diversified, a total failure here won't ruin my life, but a massive success will significantly increase my overall wealth. The shareholders actively want the company to take the risky gamble.
But now, put yourself in the shoes of the CEO or the lead finance manager. You are the agent making the decision.
The manager's perspective is entirely different. The manager is not diversified. Their entire livelihood, their professional reputation, their ego, and their primary source of income are tied strictly to this single company.
If they authorize the massive investment in the risky drug, and the drug fails in phase 3 trials, the company takes a catastrophic loss. The stock tanks. And what happens to the manager?
They are almost certainly fired in disgrace.
They lose everything.
Exactly. So, purely out of self-preservation, the manager looks at the math and decides not to take the investment. They choose to invest the company's capital in a much safer, lower-return project, maybe just a slight modification of an existing painkiller, simply to protect their job and ensure steady, unspectacular growth.
And the result? The shareholders lose out on a highly valuable opportunity to maximize their wealth. The manager's personal goal of job security actively superseded the corporate goal of wealth maximization. That is the agency problem in its purest form. The agent protected themselves at the expense of the principal.
And this inherent conflict generates what are known in finance as agency costs. These are the tangible and intangible costs borne by the shareholders to either prevent the agency problem, minimize it, or suffer the consequences of it. These costs broadly fall into two categories: indirect and direct.
Let's start with indirect.
The pharmaceutical example we just discussed, that is an indirect agency cost. It is a massive lost opportunity. The money wasn't explicitly stolen or wasted, but immense wealth was destroyed simply because the optimal wealth-maximizing decision wasn't made due to managerial fear.
What about direct agency costs? Because I imagine those are the ones that make headlines.
Yes, direct agency costs are much more visible, and they fall into two types. The first type is corporate expenditure that directly benefits the management but provides zero value to the shareholders.
Give me an example of that.
The classic stereotypical example is the CEO deciding to buy a $60 million luxurious corporate jet with a built-in sushi bar using company funds, or outfitting their executive suite with priceless art. It makes the manager's life wonderfully comfortable, and it feeds their ego, but it actively destroys shareholder value. It is an agency cost.
And the second type of direct cost?
The second type is the money the shareholders actually have to spend to police the management. Because you don't trust the managers, you have to monitor them. Paying millions of dollars in fees to external auditing firms like Deloitte or PwC to scrutinize the books and ensure the managers aren't hiding losses or stealing funds, that auditing fee is a direct agency cost. It's money spent strictly because the agency relationship exists.
Okay, so if you are a shareholder and you know the managers are naturally incentivized to avoid profitable risks, to save their own skins, or to buy themselves corporate jets, how do you fight back? The system seems rigged against the dispersed owners. How is the agency problem practically resolved? The text outlines two primary mechanisms.
You can rein in rogue management through external market forces, or by purposely incurring strategic internal agency costs. Let's look at market forces first. The free market has brutal ways of policing bad management. One major force is the growing power of institutional investors.
Who are they?
We aren't talking about retail investors with 100 shares on a trading app. We are talking about massive trillion-dollar organizations, mutual funds, state pension funds, giant insurance companies that hold huge, concentrated blocks of a company's shares.
Right.
In decades past, they were passive observers. If they didn't like the management, they just sold the stock. But today, because their holdings are so massive, they can't just sell without crashing the price.
So they are trapped. They have to fix the house they live in.
Exactly. They have massive voting power. They actively participate in corporate governance. They demand meetings with executives. They exert intense public pressure on managers to act in the owner's best interests.
Oh, I see.
If a CEO proposes buying that sushi bar corporate jet, a pension fund that owns 10% of the company will publicly issue a press release threatening to use their voting bloc to fire the entire board of directors if the purchase goes through. That intense external pressure significantly reduces the agency problem.
And then there is the ultimate market force, the apex predator of corporate finance, the threat of the hostile takeover.
This is one of the most fascinating mechanisms in all of capitalism. A hostile takeover occurs when another company or a group of investors called an acquirer targets a company for acquisition without the support, agreement, or permission of the target company's current management.
How does that even work?
The acquirer essentially bypasses the CEO entirely. They go directly to the shareholders and make a public tender offer saying, your stock is currently trading at $50 a share. We will buy it from you right now for $70 a share, but only if enough of you sell to give us majority control.
Why would they do that? Why overpay for the stock?
Because they have spotted a company that is severely undervalued precisely because it is poorly managed. The acquirer looks at the cricket bat factory and says, these managers are terrified of risk, they have idle cash, they are bloated. The company's trading at $50, but if we buy it, fire the incompetent managers, trim the fat, and take the right risks, the company is actually worth $100 a share.
It is exactly like flipping a house. You find a house in a great neighborhood that is falling apart because the current tenant is terrible.
Yeah.
You buy it, you kick the bad tenant out, you renovate the kitchen, and you capture the immense locked-in value.
That is exactly the dynamic, and here is the genius of it. The mere threat of this happening acts as an incredibly powerful psychological motivator. If a management team knows they're performing poorly, if they know they're sitting on idle cash and their stock price is lagging behind their competitors, they know they are highly vulnerable.
They know someone is watching.
They know a corporate raider is watching them, waiting to swoop in, buy the company, and fire them all. That terrifying fear of losing their jobs to a hostile takeover motivates the management to proactively act in the best interests of the shareholders. They're forced to maximize the market value of the firm themselves, specifically to make the stock price too expensive for a raider to afford.
That is brilliant. The threat of destruction enforces discipline. Okay, so those are the market forces. What about the second way of resolving the problem? Purposely incurring agency costs. This sounds counterintuitive. Why spend money to solve the problem of losing money?
Because it's about strategic alignment. You are spending money to align the manager's personal financial interests perfectly with the shareholders' interests. The most common and powerful way to do this is through incentive compensation plans, specifically executive stock options.
Walk us through how a stock option actually changes a manager's behavior.
Instead of just paying the CEO a massive flat cash salary of $5 million, which they get whether the company does well or poorly, you pay them a smaller base salary, but you give them the option to purchase a massive amount of company shares at today's price, say $50, but they can't exercise that option for 3 years.
Okay, so if the manager plays it safe, avoids all risk, and the stock just drifts sideways and stays at $50, their options are worthless. They make no extra money.
But if the manager takes calculated wealth-maximizing risks, if they authorize that new composite BAT R&D, and it's a huge hit, and the stock price soars to $150 over the next 3 years, now the manager can exercise their options.
Wow.
They can buy the stock at $50 and immediately sell it at $150. They personally make tens of millions of dollars. Suddenly, the manager desperately wants the stock price to go as high as possible. You have completely aligned their personal greed with the shareholders' desire for wealth maximization. They are in the exact same boat, rowing in the exact same direction. You spend money and agency cost in the form of giving away equity to definitively solve the agency problem.
It's beautifully cynical and highly effective. So we have covered the theoretical framework. We know the what, the why, and the interpersonal psychological drama of the agency problem.
Yeah.
Let's move to our final conceptual block before we wrap up. We know what corporate finance does, but practically speaking, who is actually sitting at the desks doing all this work?
Okay.
How is the finance function physically structured within an organization?
This raises an important question, right? Because the structural organization is highly dependent on the size and the nature of the firm. It is an evolutionary process. It is not a one-size-fits-all model.
Where do we start?
If you go back to the very beginning, a small business, a sole proprietorship, let's say it's literally just you in your garage making those custom cricket bats. You are the entire finance function. You estimate the funds you need. You drive to the local bank to arrange the small business loan. You prepare the monthly cash budget on a spreadsheet. You inspect the receipts. You call the local clubs to collect cash from your debtors. There is no separate financial officer. You wear all the hats.
But as the company grows from a garage to a regional factory, that becomes physically impossible. You cannot be on the factory floor inspecting the willow wood while simultaneously negotiating complex lines of credit with a syndicate of commercial banks.
Right. So as you transition into a medium-sized firm, you are forced to decentralize. You might hire a dedicated financial controller or a treasurer to take over those specific financial responsibilities so you can focus on operations. But the text asks us to scale up even further. How does a massive corporate form of business handle this? When you have thousands of employees, operations in multiple countries, and billions of dollars in revenue, the finance function becomes incredibly complex and highly dangerous if mishandled.
The text gives us an actual organizational chart for this, figure 1.2. And if you are studying, it is crucial to understand the hierarchy and the specific separation of duties here. At the very top, you have the board of directors. They represent the shareholders. They hold the ultimate legal authority. They delegate the day-to-day executive power down to the managing director, or the MD, often called the CEO in modern parlance.
Yes. Now, sitting horizontally between the board and the MD, there is often a specialized group called the Finance Committee.
What do they do?
The Finance Committee is a critical advisory body. It is typically headed by the managing director and includes the chief financial manager and various department heads, like the head of production and the head of marketing. Their job is to advise the board on high-level financial planning, review the major capital budgets, and ensure that the financial goals are perfectly coordinated across all the different operational departments.
They keep everyone in sync.
Exactly. They ensure marketing isn't planning a $50 million ad spend, while production is planning a $50 million factory expansion if the company only has $60 million in the bank.
Okay, so dropping down below the managing director, you have the financial manager or the CFO. They are part of the elite top executive team. But below them is the critical structural split that you absolutely must remember for your exam. Because the sheer volume of financial work is too massive and the risk of fraud is too high for one person, the finance function is formally split into two highly distinct subdepartments.
You separate the handling of the money from the tracking of the money.
That's fascinating. Tell me about the first one.
This separation of duties is the bedrock of internal corporate security. Let's look at the two roles. For the actual physical handling of the corporate finance, you appoint a treasurer. The treasurer's orientation is primarily outward-facing.
Outward-facing. Okay.
They are dealing with the external financial markets. They procure the essential funds from the banks or Wall Street. They maintain the vital relationships with the commercial bankers and investment bankers. They manage the daily cash balances and the investment of surplus funds.
So they actually touch the cash?
Yes. They handle credit management, which means deciding which external customers are trustworthy enough to buy our bats on credit. They handle the physical distribution of dividend checks to the shareholders, and they manage the vast assets of the corporate pension fund. If it involves actual, tangible cash moving into or out of the firm, the treasurer is the one holding the wheel.
Okay, so the treasurer is moving the money. On the other side of the split, you have the controller. The controller's orientation is entirely internal. They are the tracker, the rulemaker, and the analyst. The controller manages the general corporate accounting and the highly detailed cost accounting of the factory floor. Crucially, they handle the internal auditing function to make absolutely sure that funds aren't being embezzled or misused by other departments. They're responsible for the meticulous preparation of the budgets, the long-term mathematical planning, controlling the variances in operational costs, and generating the statistical reports that the board reads.
It is an elegant system of checks and balances. Think about the friction it creates, which is highly intentional. The person who authorizes the expenditure and tracks the budget, the controller, is legally not the same person who actually signs the check and moves the money out of the bank account, the treasurer.
That's so smart.
If the controller wants to steal money, they can fake the budget, but they don't have access to the cash. If the treasurer wants to steal cash, they can't, because the controller's audits will immediately spot the missing funds. Understanding this division of labor is absolutely critical for understanding corporate governance.
Governance being the system of rules, practices, and processes by which a company is directed and controlled. As the text notes, proper governance is a key function because a manager wants to ensure they're acting in the best interest of the dispersed shareholders while rigorously managing risk.
Yeah.
You can't have good governance if one person holds all the keys to the kingdom.
Exactly. This bifurcated structure creates a transparent, highly efficient system where immense amounts of capital can be procured safely, allocated mathematically, and utilized optimally, fulfilling the entire mandate of the modern approach to corporate finance.
All right, if you are prepping for your exam, we have covered an immense landscape today. We've gone from the theoretical to the intensely practical. As we head into the outro, I want to quickly synthesize the major mental models you need to have locked in for Unit 1.
This is a great idea. Let's summarize.
First, remember the historical shift. The traditional approach from the 1930s was just a vault procuring funds to survive. The modern approach from the 1950s onward is an analytical discipline of procuring, efficiently allocating, and utilizing those funds.
Right.
Got it.
Second, the big four decisions. You have investment decisions, which is clearing the opportunity cost hurdle to buy long-term assets. You have financing decisions, which is balancing the cheap leverage of debt against the bankruptcy risk to equity. You have dividend decisions, which is the psychological game of distributing profit versus retaining it for growth. And you have liquidity decisions, which is managing the daily profitability versus safety trade-off of working capital.
Perfect. Third, and perhaps most importantly, remember the supreme goal. It is never the ambiguous, easily manipulated metric of profit maximization. It is always wealth maximization, which is definitively measured by maximizing the current market value per share of the existing stock.
That's a huge one. Fourth, you must understand the inherent friction of the agency problem, the human reality of managers acting in their own self-interest rather than the shareholders, and how that conflict is mitigated by both market forces and strategic agency costs like stock options. And finally, know the organizational split. The treasurer handles the external movement of the money, and the controller handles the internal tracking and budgeting of the money.
Those are the foundational pillars. And as you put your notes away and prepare to walk into that exam, I want to leave you with a final thought to mull over, something that builds on the underlying philosophy of everything we just discussed. Consider the paradox of the hostile takeover. The name itself sounds incredibly aggressive, predatory, and deeply negative. The phrase corporate raider conjures up cinematic images of pure destruction and greed. But if you truly internalize the principles of corporate finance, of the agency problem, and of wealth maximization that we built today, you arrive at a fascinating, almost countercultural realization.
You really do. The realization that the mere threat of a hostile takeover might actually be the greatest, most effective protector of shareholder wealth that exists in the entire free market ecosystem. It is the ultimate sword of Damocles hanging over the heads of comfortable, entrenched management.
It forces executives to wake up every day and be hyper-efficient. It forces them to take bold but mathematically calculated risks. It forces them to relentlessly pursue the maximization of the firm's true value rather than getting safe, fat, and complacent with the shareholders' capital. How does truly understanding that underlying financial mechanism change how you view the so-called corporate raiders on Wall Street?
It flips the whole mainstream narrative entirely on its head, doesn't it? It turns the cinematic villain into the vital immune system of the free market.
I love that perspective shift. Listen, you have put in serious time and focus today. You've walked the floor of the cricket bat factory with us, from the initial legal incorporation all the way to analyzing the dividend distribution. You don't just know the definitions now. You understand the how and, far more importantly, the why of corporate finance. We wish you the absolute best of luck on your MBA exam. You are fully prepared to crush Unit 1. Keep that mental engine running Keep those cash flows precise, and we will catch you on the next deep dive.